So let's start this second round from the southern part of the continent. South Africa's Trade Minister updated is optimistic the country's growth rate can be raised to above 1% again in 2017 thanks to the rising mineral prices. Speaking on the sidelines of the annual World Economic Forum, the minister says mineral prices have moved up a bit, so there is room to be slightly optimistic.
We had the good fortune of avoiding what some of our peers had, which was actual recession. But we're going to end up with a growth rate lower than 1%. I don't think the final figure's in yet, but lower than 1%, which is not good. But I think we are optimistic we can do a bit better this year. The drought that we had last year is not with us any longer, nor the mineral prices have moved up a bit. So I think we have room to be slightly optimistic. The challenges, I think, are going to be what is going to be the state and shape of the global economy. We as South Africa, I think, and part of the African continent, need to see our future as moving up the value chain, industrialization. Of course, we're industrializing right in the midst of the fourth industrial revolution, which will have very profound effects on the models. Perhaps the good news is that where we've seen robotics and digitized processes introduced in firms in South Africa, we've seen our people are perfectly capable of managing those processes and achieving good results. But the challenge, of course, is that those people that are doing it have got some or other post-secondary qualification and in some ICT or engineering-related subject.
U.S. oil prices today moved away from one-week lows breached in the previous session, with investors turning their attention to upcoming government data on U.S. inventories. You heard that the U.S. oil output may breach 9 million barrels per day, one of the highest around the world, of course coming behind other producers such as Saudi Arabia. Meantime, the IMF is predicting oil prices will rally about 20% in 2017, despite the lows in 2016. Crude prices was higher by as much as 52%. So let's discuss more with a financial analyst from financial derivatives company. One of the research analysts there, Nosike Nwajide, is joining us on this show this afternoon. Nosike, good afternoon. Good to see you.
Good afternoon, Bosun. Thanks for having me.
It's always a pleasure discussing with you when oil prices are looking very sweet. So I just have to put that there because it makes discussions with you analysts very interesting. Everybody likes it when oil prices climb. So do you think IMF is a little bit optimistic about 20% outlook in crude prices for the current year?
Yes, I think this current forecast projection is rather optimistic. 20% oil prices pushed 65 above $65 per barrel. If you look at current oil industry, I'm giving the deal between OPEC and non-OPEC countries to cut output by about 1.8 million barrels starting January. So far, so good. And the market is a bit bullish on the fact that the OPEC countries will cut production. Saudi Arabia has already cut production by as much as 486,000 barrels a day. But on the other hand, as prices rise as a result of the production cuts, the U.S. shale producers also increase their output. They have incentive to increase their output to match prices. Oil industry dynamics has changed so much that the OPEC producers are no longer the price givers; they're now price takers. Basically, oil prices are capped at the production cost or the average production cost of shale oil in the market. And with rising prices, shale oil producers will pump more into the market. But the IMF predictions are basically optimistic that whatever production cuts they can get from OPEC and non-OPEC members will outweigh whatever increases in outputs from the shale oil producers. So that's what the projections are based on.
In all indications, do you think, with Saudi Arabia saying that, well, it looks like this haircut is not likely to extend beyond June, do you think the party will be over by sometime in June, again with all U.S. production or U.S. output, some forecasts say to be about 9 million barrels per day?
Well, the current deal is expected to last till June. And the OPEC and non-OPEC members will probably get together and see, in case or might want to get together to propose another deal. There's also the normalization of monetary policy in advanced countries that is reflective of improving economic conditions, and OPEC expects increased demand as a result. Now, if demand goes up, whatever excess is in the market beyond June, they hope that the increased demand will mop up the excess. Now, production in the US going as high as 9 million barrels a day. That was a projection made last year, and it's just barely 3 weeks into January, and they are already at 8.95 million barrels per day. So, after June, we expect what we expect over here is that oil prices will still be in the range of 55 to 60, and that shale oil production will go up to mop up or to fill up any void caused as a result of OPEC production and non-OPEC production being removed from the market.
Nosike, I'm going to ask this question. Nigeria got an exemption from the current cutback deal. Do you think if we're steady around 1.8 million barrels per day, that perhaps that exemption could be lifted and we will come under the knife? That's Nigeria speaking, sometime this year. Was that likely to happen?
I think Nigeria's exemption will continue. I think OPEC has bigger problems in the form of Iran and Kuwait, and even Libya, who have just gone back. Their oil terminals are back in their possession, and they hope to really ramp up production. Iran hopes to, after its sanctions have just been lifted, hopes to ramp up production to as much as 3.8 million barrels a day. And there's always Russia, who as late as last year were saying that at the end of 2017 they would ramp up production. But I think Nigeria's oil production benchmark is at 2.2 million barrels a day. An increase of 400,000 barrels will not be that significant in the market. So I think Nigeria's exemption will continue. Okay.
I think that's some news that folks in Abuja will be happy to hear. Thanks for reinforcing that. Nosike from Nwajide from the research analyst, financial derivatives company here in Lagos. Thank you for your time. Let's go to the north of the continent, where the IMF just released a report that Egypt is on track to receive the second tranche of the $12 billion 3-year loan, pending a visit in the end of February to review progress on its economic reform program. The IMF originally approved the loan intended to jumpstart an economy battered by years of turmoil that has driven away investors and tourists in November, when it released the first $2.75 billion in installment. The IMF staff report from November, released on Wednesday, showed Egypt will scrap its remaining caps on transfers and deposits of foreign currency by the end of June and overhaul its oil sector. In a related news here in West Africa, Togo has reached an agreement with the International Monetary Fund for a 3-year program that could, subject to the IMF board approval, be supported by a $238 million loan package. And that's according to the IMF latest report today. The agreed economic program aims to improve the living conditions for the population and to maintain a stable macroeconomic environment that is comparable with public debt sustainability. And finally, Zimbabwe's tax agency, ZIMRA, says it failed to meet its 2016 revenue target by 4% as Zimbabwe's economy stalled amid weak global commodity prices hitting mineral royalties. That's about all for today. We thank you for watching. I'll see you again.